Hey everybody, it's Mr. Forgione. Today we're going to actually get into something a little bit more fun than accounting and exchange rates. Don't get me wrong, I know that you guys have been so pumped up about doing accounting and exchange rates. You've probably told all your parents, hey, I found my calling, this is what I want to do. But we're actually going to get away from that. We've covered everything basically that there is to cover Cambridge wise. So I'm going to take these last couple of weeks and get into a little bit more, what I would consider to be more entertaining or fun stuff. And specifically, what I want to talk to you guys about today is stocks. Now, with stocks specifically, what I do with regard to evaluating stocks or trying to figure out what's a good stock to buy, there's a number of ways to come at this. And the PowerPoint that I sent out is basically one of my methods that I use, which is a value based system. Essentially, what I'm trying to do when I'm picking stocks or when I'm investing in stocks, I should say, is I'm trying to find a stock that I believe is on sale. In other words, I want to buy ownership in a company at what I think is a really good price, a lower price than what it's actually worth. And so later on, I can sell it at a much higher price and make money on that investment. That's kind of the goal here. And so that's the approach that I take. There are different approaches. There are people that do what's called speculation. There are people that follow what's called technical analysis, which is where you follow the trends in a stock and sort of look for, well, when it bumps here, when there's a price gain here, then it's likely to do this. So there's a lot of different things that you can do. That's not what I do. I'm more of a value investor. That's the approach that I take, although on a much smaller scale than a lot of other guys. But that's kind of what I want to talk to you guys about and teach you. Now, before I get into any of that, the first thing that we always want to look at is what stocks or what companies do you think would be kind of cool to invest in? And you guys have a unique perspective because being 16, 17, 18 years old, you know what's cool. You know what's trending. You know what is sort of the next thing. People like me, I'm 40 years old, it doesn't really work like that. I don't really know what's going to be the next big thing. Everyone says, oh, I'll be different when I get older, I'll be cool. No, you're not. You're going to be just as lame as everybody else as you get older. But the good thing is I'm around you guys, and so I kind of, I don't want to say use y'all, but sometimes when I hear you guys talk about a particular company or whatever, that does sort of, set off some alarms for me. Oh, okay, this may be something that's eventually catches on, is real popular, etc. So first thing, as I mentioned on Google Classroom, I want you guys to try to come up with a list of a few different companies. I would say somewhere, let's say 6 to 10 different companies to sort of look at, and then we'll go through and sort of look at those different companies and whether they're good investments or not. Now, with this video, the other thing I want you to do is go ahead and pull up the PowerPoint that I sent out, and we're going to kind of go through the criteria. I listed 5 specific criteria there. There's 3 really important ones, and then one that's kind of a personal preference, and one that's a tiebreaker for me. There's other criteria that we can get into as well if you guys really like this stuff, but this is just kind of the basics. Okay, so if you need to pause the video, go ahead, pull up the PowerPoint. We're going to go through some of the different criteria. Okay, so the first criteria that we have listed is what's called the PE ratio. Now, PE stands for price to earnings. The price that we're referring to is not the price of the good that we're selling. So if we're looking at PepsiCo as an example, we're not talking about, oh, what's the price of a Mountain Dew? We're talking about the price of one individual share of stock of ownership in that company. And then we take the price of that and we divide it by the earnings that the company made per share of stock, per share of ownership. So it's the price of the stock divided by the earnings per share of that stock. Now, what I've listed on the PowerPoint, what I personally believe is an okay-ish sort of PE ratio is 25 or less. Okay, that's what I believe. If it's inside of 25, I start at least listening. Under 18 is actually pretty darn good. So that's kind of what I look at personally from the standpoint of a value investor. I don't want a high PE ratio. Lower is better here because I'm trying to get something on sale. Okay, basically, one of the investors that I kind of like in terms of a philosophical standpoint is a guy by the name of Phil Town. And he always talks about what you're trying to do with investing. You're trying to get a $10 bill, but only paying $5 for it. Okay, and so that's what we use the PE ratio to see. Okay, is this on sale? If it's under 25, okay, that might be pretty decent. If it's under 18, yeah, that's going to be pretty good, or at least it should be pretty good. It's an indicator that this could be a pretty good stock for us to buy. Now, we don't want to just look at that. We want to look at some other factors as well. And the second one that I personally look at is the dividend. So, a dividend is the portion of profits that a company pays out to its stockholders, to its owners. Most companies that are making profit will have some type of dividend that they pay out. Some don't, though. There's a lot of companies that actually don't pay any profits to their dividend or to their shareholders. Amazon is an example of a company. They don't have a dividend. They don't pay any portion of the profits to their actual shareholders. Now, if you're not paying a dividend, the concept or the reason that people say, "Oh, I'm not paying a dividend," is that they're reinvesting it. They're putting that profit back into their company. And that's fine, especially for companies that are first starting out. I can kind of understand that a little bit, but for me personally, a dividend can be really beneficial, and I'll give you an example. An average dividend is around 2% or so. Okay, so we want a higher dividend. We want more cash. If you're up in that 3% range, that's pretty good. Okay, you're in 3%, that's good. Here's the reason that that's important. If I look at an average return on investment is probably about 8% per year. Okay, if I have stock A that gives me 8%, the price has basically gone from $100 to $108, but it doesn't pay a dividend. And stock B has that same 8% gain, $100 to $108, but it pays a 3% dividend. Okay, in other words, now I get an extra $3 per share on that. My total return on that stock is now 11% for the year instead of 8%. You go, okay, what's the big deal there? The big deal is I take that extra 3% times however many shares I've got, and I reinvest it in shares. I buy more shares of stock, and eventually they pay more dividends, and I take those dividends and invest them, and it keeps growing. So as an example here, for a share of stock or for a company that's only giving you 8% per year, that company is probably going to double in value, and your investment will double in value about every 9 years. By comparison, a company that is giving you an 11% return with that dividend, that investment is going to double about every 6.5 to 7 years. So you're actually saving a couple of years of life on your investment. That means if you're investing for 30 or 40 years, you're getting exponential growth in terms of how much money you're making off that stock because they have a higher dividend. So we like high dividends. That's always a good thing. Okay, the next thing, the third major criteria that we look at is the 52-week range. Now, we know 52 weeks is 1 year. Why they don't just call it the 1 year range, I don't know. But they call it the 52-week range. And it's basically two numbers. It's the lowest that the stock price has been in the last year, and it's the highest that the stock price has been. We want the current price to be closer to that first number, closer to the low end. And the reason being, if it's closer to the low end, we go, oh, that could be anyway undervalued right now. We know it at least can get back up to what it's been in the last year. We know it can because it's done it. We've seen it do it. Okay, we've actually seen that stock at a much higher value. We know it can get back there, so we want to get it while it's on the low end. That's a pretty good indicator that it could be a good deal. An example of a company where they took a hit and then just kept right on rolling is McDonald's. I may have mentioned this before. Maybe 10 years ago, McDonald's had, there was a scare because there was mad cow disease, and people were thinking, oh, what if it gets into McDonald's beef? What can happen? People can get sick and sue McDonald's and all that. Which, first off, is hilarious that people thought McDonald's is beef. But anyway, they ended up they did fine. People went that went to McDonald's went, okay, I'll just get the McChicken or the McNuggets or whatever McThing that they want to get. And McDonald's just kept right on rolling. And guess what happened to the stock price? After that dip, it went right back up in the long term. So that's one of the things that we can kind of look at. Is we're looking for those rebound stocks. They've got knocked down for one reason or another, like, maybe coronavirus. And then we're trying to get them as they go back up. Okay, next thing that's on there, the fourth criteria, this is a personal preference one. It's the market cap, the market capitalization. This basically shows you if a company is, by and large, a large or a super large company or a smaller company. It doesn't really matter which it is in terms of, neither one is good or bad. It's a personal preference. I will say that smaller cap companies tend to provide greater returns, but they're also much riskier. So you can lose a lot more money on small caps than with large companies. So an example of what I'm saying here, if you buy Coca-Cola, Coca-Cola is a massive company, huge large cap company. You are not going to get rich on Coca-Cola stock, but you're probably going to get steady, kind of boring, but steady gains over the course of time. It's not very risky. You're not going to get high returns, but you'll do okay. You'll probably do okay on Coca-Cola. By comparison, if you're investing in a small cap company, a company that a lot of people don't necessarily know about, it's much riskier. You could lose a lot of money, but there's also the potential for you to gain a lot of money. So I always kind of tell this story. There was a company, 15, 18 years ago, somewhere in that ballpark, that I had bought stock in. And I talked about this in class several years ago. Someone asked, hey, what was the most you ever made on an investment? And I talked about this company. And it was a small company that made tiny motors that you could use in anything from cell phones to toy airplanes and toy, radio controlled boats and stuff like that. It could be used in a variety of things. I think I bought them when they were $1.25 a share, somewhere between $1.25 and $1.50 a share. And then I turned around and sold them like 9 months later for $4.25 a share. So basically, I tripled my money or over tripled my money in about 9 months on that particular stock. Now, as I'm telling this story, I'm kind of puffing my chest out a little bit, going, Mr. Forgione knows what's up. I happen to mention the ticker symbol to my students, and I have a student that's checking on his cell phone and goes, have you looked at the price of that stock lately? I said, nah, I haven't looked at it at all. And this is probably, like I said, 5 years later. He goes, yeah, you don't want to see it. I said, no, I do. What's it up? It was at $19 a share at that point. Basically, had I taken, let's say, $5,000 of money at that particular point in time, if I'd invested $5,000 in that stock, I would have almost $100,000 5 years later. You can make a lot of money on small caps. Obviously, I got out too soon. But you can make a lot of money on small caps. The problem is you can also lose a lot of money. So it's just kind of a personal preference. Okay, the last one, the fifth one, is insider transactions. This is going to be a tiebreaker. I don't look at this first, but if I'm like, okay, the PE's good, the dividend's good, 52-week range is so-so, I don't know, maybe this will come back, I don't know. Then one thing I kind of look at and say, all right, this may be a good tiebreaker, is insider transactions. Basically what this tells us is people that work inside the company, it's a log that shows, are they buying company stock or are they selling company stock? Now, the reason that's important, insiders actually know the ins and outs of the company. And so if let's say that Justice is he's a general manager of, let's say, a Foot Locker, okay? If he is buying company stock in Foot Locker consistently, I may look at that and go, all right, Justice works there, he manages there, he's buying a lot of stock. Foot Locker must be doing pretty good. He knows what's up. This may be a good company for me to get into. By comparison, if Justice as a GM is selling his corporate stock consistently, maybe he's getting stock as bonuses and he's just selling it, that kind of clues me in, oh, he doesn't have a lot of confidence in the company and he works there. Maybe he knows something and maybe I should stay out of it. So that's kind of my 5 big ones. Now there's some other ones I can get into if you guys are interested in this stuff. But here's what I want you guys to do. Kind of take this in, you know, think about it a little bit, and then take this list of stocks that you're going to look at, and I want you to go on either Yahoo Finance or Google Finance. I was hoping to be able to have the projector up to be able to kind of show this to you. But I want you to go on one of those, and I want you to look at these metrics for these individual stocks. And I'll send out a sheet that kind of lets you look at these and record them. And start analyzing, hey, are these good stocks to buy? Are they not, based on these few 4 or 5 criteria? Hope you all are doing well and hope to see you all soon.